There's something deeply disturbing happening right now in the world's most powerful financial institutions, and almost nobody is talking about it. Central banks around the globe are buying gold at a pace not seen since the 1960s. We're talking about India, China, Russia, the Middle East, even wealthy European nations. They're all accumulating precious metals like their financial lives depend on it. But here's what most people miss. Central banks don't panic buy. They don't chase trends. They don't follow retail investors on social media. When central banks move, it's because they know something about the future that the rest of the market hasn't priced in yet. And if they're this aggressive about gold right now, it means they're preparing for something that most of us still believe can't happen. So the question you need to ask yourself is simple. What do they know that you don't? Right now, if you're paying attention, you're probably confused. Maybe you're even frustrated. The stock market keeps hitting new highs. The dollar still dominates global trade. Inflation came down from its 2022 peaks, right? So why would central banks be acting so concerned? Why would they be moving away from dollars and into something so unglamorous, so unsexy as gold? The mainstream narrative says everything's fine. The Fed has it under control. Maybe we'll have a soft landing. Maybe there's no crisis coming at all. But then you see the numbers that don't fit the story. National debt exploding past $34 trillion. Interest payments on that debt hitting levels that haven't been seen since the 1990s. Geopolitical tension rising by the month. Middle East instability. Taiwan tensions. The dollar's international dominance slowly but visibly eroding. You feel it in your bones that something is off. But everyone around you seems calm. The financial media seems calm. So either you're paranoid, or the institutions that actually manage trillions of dollars understand something the average person doesn't. Spoiler alert, it's the second one. Here's what's actually happening, and I'm going to break this down step by step so you understand exactly what central banks are doing and why. Step 1. The dollar system that's existed since 1944 is under structural stress. For 80 years, the world has accepted US dollars as the global reserve currency. Every major oil trade happens in dollars. International debt is denominated in dollars. Central banks hold dollars as their primary reserve. This has given the United States an enormous privilege. We can print money, we can run deficits. The rest of the world absorbs it because they need dollars to do business. But that system has a timer on it, and central banks know how fast that timer is counting down. Step 2. The debt mechanics have reached a critical threshold. The US government now spends more on interest payments than on defense. Think about that. The defense budget used to be the largest line item. Now it's not. Interest on debt is. This year alone, we're paying nearly $700 billion just in interest. Next year it'll be higher. The year after, higher still. This isn't opinion. This is arithmetic. When interest payments spiral like this, you have three choices. Raise taxes, cut spending, or devalue the currency. No politician chooses the first two. So the system defaults to the third option, devaluation, which is a genteel word for inflation. Step 3. Central banks understand that this devaluation is coming, and they're positioning accordingly. When a currency is going to lose purchasing power, you want to hold assets that maintain value regardless of currency. Gold isn't a currency. It has no yield. It's not productive. But it's a hedge. It's insurance. It's a way of saying, I don't trust where this is going. And so central banks are buying. China's been buying quietly for years. India just declared massive gold purchases. Even the ECB, even central banks that supposedly benefit from the dollar system, are diversifying into gold. But that's only the surface explanation. The real mechanism is much more sophisticated. Central banks are signaling to each other. They're coordinating without saying a word. The message is, we're hedging against currency devaluation. You should too. It's a subtle run on the dollar, happening in slow motion, in central bank vaults around the world. Here's what most financial commentators won't tell you. This pattern has happened before. Look at the 1960s. The US was running persistent deficits. The gold standard was supposed to be inviolable. But institutions around the world started asking an uncomfortable question. Can the US actually back all these dollars with gold? And so they started converting dollars into gold. By 1968, the situation became undeniable. The US had to break the gold standard. Nixon closed the gold window in 1971. It happened because enough institutions lost faith in the currency system simultaneously. Look at the 1970s. Stagflation. Soaring inflation, stagnant growth, and precious metals outperforming everything else. The S&P 500 went nowhere for a decade. Gold went from $35 an ounce to $850 an ounce. Real assets outperformed financial assets. It wasn't a cyclical correction, it was a regime change. Look at the 2008 financial crisis. When Lehman Brothers collapsed, central banks realized that the system was more fragile than anyone publicly admitted. After 2008, they never really tightened. They just kept easing. They kept printing money. And precious metals investors who understood what was coming made extraordinary returns. Look at 2020 to 2023. Unprecedented government spending. Unprecedented inflation. The Fed suddenly hiking rates faster than expected. Gold went up, silver went up, and investors who saw that pattern coming years in advance positioned themselves accordingly. History shows this pattern again and again. When central banks lose faith in the currency system, they buy gold. When they buy gold, it's because they're preparing for something that will surprise the general public. Why this time feels different. But this time, the setup is different, and scarier. In 1968, we had time. In 1971, we had a political solution. The US could abandon the gold standard and move to a floating currency system. It worked. The system reset. In the 2008 crisis, the damage was containable. The central banks coordinated globally. They flooded the system with liquidity. They bought bonds. They pushed rates to zero. It was extreme, but it worked. This time, we don't have those options. First, because the debt is so much larger. We're not in the hundreds of billions of deficit spending, we're in the trillions per year. We've crossed a threshold where interest payments become self-reinforcing. They spiral upward no matter what you do. Second, because geopolitical fragmentation has fractured the global coordination mechanism. In 2008, the world's central banks acted as one. Today, China, Russia, and Iran are actively building alternative systems. The BRICS nations are talking about de-dollarization. Sanction regimes have shown countries that holding dollars is risky. You can be cut off from the system. So they're diversifying. Third, because the structural problems are different. This isn't a cyclical recession we can inflate our way out of. We have supply chain fragmentation. We have aging demographics in developed nations. We have energy transition costs that are enormous. We have debt that can't realistically be repaid. When you combine massive debt, geopolitical fragmentation, structural headwinds, and central bank gold buying, you're not looking at another business cycle. You're looking at a regime change, a shift in how global finance operates. And this is where everything changes. So what happens next? Let me walk you through the likely phases. Phase 1 is denial. We're already in it. The mainstream says, it's fine, it's transitory, the Fed's got it under control. This phase can last years. During this phase, financial assets still perform okay. Stocks still have rallies, bonds still pay yields. Most people feel like the system is stable. But it's not. It's corroding from the inside. Phase 2 is recognition. It's the moment when enough financial institutions, enough smart money, enough institutional capital realizes that the path the system is on is unsustainable. This is where we might be heading. In this phase, you see rotations out of long-duration assets and into real assets. You see bond yields rising faster than expected. You see volatility picking up. You see central banks becoming even more desperate with their policy tools. Phase 3 is acceleration. This is when the general public realizes something's wrong. When they watch the news and hear about currency concerns or inflation or geopolitical risk. This is when capital really starts to move. This is when gold isn't just a macro hedge anymore. It's a necessity. It's when silver starts to move. It's when real assets outperform financial assets dramatically. We've seen historical examples of this moving very fast. When the consensus breaks, it can shift in weeks, not years, weeks. And smart money knows this. Institutional investors know this. Central banks know this. That's why they're positioning now, while prices are still reasonable, while the general public still thinks everything's fine. So what should you actually watch? If you're going to understand what's happening before it becomes obvious to everyone else, what are the signals? First, watch the dollar index. The dollar's been strong for several years, but that strength is increasingly dependent on rate differentials. As other central banks consider raising rates, or as the US considers cutting rates again, the dollar becomes more vulnerable. Watch for sustained breaks below the 200-day moving average. That would signal institutional money rotating out. Second, Watch central bank gold purchases. We're already seeing historical levels, but watch if it accelerates further. Watch if central banks start being more public about it. If they start talking about it explicitly, it means they're no longer worried about sending signals. They're worried about time. Third, watch the Treasury yield curve, specifically the 10-year yield. If we see sustained moves above 5% while the Fed is cutting rates, that's a sign of real concern about long-term inflation and currency debasement. It means institutional money is demanding higher yields to hold long-duration debt. It means they've lost confidence in the currency. Fourth, watch precious metals buying pressure from non-central bank institutions. When hedge funds, pension funds, and corporate treasuries start moving money into gold and silver, it's a sign that the regime change is moving from the institutional level to the general investment level. These four indicators don't move in a straight line, but they're all pointing in the same direction right now, and they're accelerating. Here's what I think is coming, and I say this with conviction based on the structural setup. Over the next 2 to 5 years, we're going to see a significant repricing of real assets relative to financial assets. Gold and silver will be part of that repricing. Mining stocks will be part of that repricing. Energy will be part of that repricing. Real estate in certain markets will be part of it too. This doesn't mean stocks go to zero. It means that nominal returns on stocks might be okay, but in real terms, adjusted for inflation, they underperform significantly. Meanwhile, assets that aren't dependent on the currency system maintaining its value will outperform. The dollar will still be used internationally, but it will lose market share to alternative systems, alternative currencies, and alternative stores of value. Some of that goes to other fiat currencies initially, but ultimately, it goes to real assets. Central banks know this. They're not buying gold because they think it's going to $3,000 an ounce in a year. They're buying it because they're preparing for a world where the currency systems we take for granted work differently than they do today. And the most important thing to understand is this. When central banks move, retail investors usually have time to follow. But not much time. Not years. Maybe months. Maybe weeks once the move accelerates. So let me be direct with you. Central banks around the world are buying gold at a pace not seen in generations. They're doing this because they understand that the current dollar system is on an unsustainable path. They know that debt, geopolitics, and structural factors are converging to create a regime change. This doesn't mean panic. It means prepare. It means understanding that the financial world you've grown up in is shifting. It means diversifying away from a system that's slowly losing credibility on the global stage. The institutions that manage trillions are positioning. They're not doing this loudly. They're doing it methodically, strategically, and carefully. But they're doing it. The question for you is whether you want to follow them, or whether you want to wait until the rest of the market figures it out and prices have moved dramatically. History shows that the best opportunities come from understanding where the system is going before the consensus gets there. Central banks are giving you the signal right now. The question is whether you're paying attention. If you want more deep macro analysis like this, more insights into what institutional money is actually doing, subscribe and stay close to the channel, because the next 2 years are going to be defining years for anyone's financial future. The system is shifting, and that shift is starting now.